Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit about the markets again, but before we do that, we'll just have a quick look at indice returns from around the globe. You know, we're 3/4 of the way through 2013, and we've got the TSX up 3%, Chris, but the Dow Jones Industrials is up about 18%. When we look to Europe, we've got London up 10%, France and Germany are up 13%. Tokyo's up 37%, and Hong Kong's up about 2%. So again, the case could be made for global diversification, certainly. But we wanted to focus a little bit today on fixed income or bonds. You know, the market's main issues at the moment revolve around what's happening in the bond market and what the U.S. Federal Reserve may or may not do with regards to interest rates and tapering this quantitative easing that they have. And that's having an effect in most portfolios where we have rising bond interest rates, takes bond prices down negatively, of course, and most importantly, probably the equity investors, is that takes equity income sensitive issues lower. So, Chris, why don't we just step away from that and talk about the whole idea of fixed income in a portfolio?
Sure. Well, people might be most familiar with Canada Savings Bond. You'd buy a bond at a certain coupon rate, hold it for the maturity. You never really saw any movement or wiggling around of the bond prices, but technically, when interest rates rise, bond prices fall. So if you buy a bond in the open market and interest rates are on the rise, you're going to see the price of that bond decline depending on the degree of rise in interest rates. In theory, bonds have always been owned in portfolios for diversification, stability, income, and a lower volatile investment. But we need to remember that we've been in a declining interest rate environment for 30 years now.
Yeah.
So bonds in our recent history, being the last 30 years, have had a bit of a tailwind with rates declining. Now we've hit kind of a bottom, and over the last 3-4 months, we've seen yields start to rise.
You know, you can pinpoint that on a calendar. If you look at 10-year bond rates at the end of April to where they are now, you'll see an increase of about 1.1%. It's pretty hard to get away from that unless you've got exposure in the corporate bond market, where the bond pricing really is more relevant to the strength of the balance sheet of that company and what it does and how profitable it is, as opposed to what the interest rate environment is. Now, it is affected somewhat by that versus government bonds, Chris, which are, you know, very heavily influenced by the move in interest rates. So, you know, when we look at corporates, for instance, we just saw Verizon in the U.S. come out with a huge bond issue in the corporate world, $49 billion at 5.1%. It was 2 times oversubscribed, so lots of interest in it. Versus what we're seeing some of the governments do in Canada, particularly the provinces. When you look at Ontario and Quebec, they've gone out and they've reissued their government bonds with very, very long maturities on them because they're trying to take today's rates, grab a hold of them, and lock them in for a long period of time, expecting rates to rise.
That's right. Now, with this recent rise in yields, corporate bonds have held up much better than government bonds, and shorter dated maturities will give you some protection against that wiggling around of interest rates. So watch your fixed income exposure and talk to your advisor about that. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue our discussion around some of the market issues. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.